Welcome to the Ultimate Explainer. You know, if you've ever looked at a chart and felt like the market is just this chaotic, completely unpredictable beast, well, you're absolutely not alone. But what if I told you there's actually a hidden mathematical order right underneath all that noise? Today, we're diving deep into the psychology of the market. We're going to decode its true heartbeat using the incredible mathematical edge laid out in Franklin Oocho's Secrets of a Pivot Boss. Think about it for a second. Most traders out there are hopelessly glued to lagging indicators, right? They're constantly looking backwards. It's frustrating because honestly, by the time your moving averages cross, the real move is already over. It's exhausting. But here's the million-dollar question. Can a simple formula actually predict market breakouts before they even happen? The answer is a resounding yes. When you apply standard math correctly to the market's daily extremes, it literally stops being a historical record and transforms into a leading indicator. It actually forecasts future behavior. So here's our roadmap for today's explainer. First, we'll hit the expanded floor pivots. Then, we'll look at the central pivot range, followed by pivot width forecasting, two-day pivot relationships, and finally, we'll wrap up with executing the magnet trade. All right, let's jump right into part one, the expanded floor pivots, and why we need to move beyond the standard. Decades ago, floor traders were literally calculating these levels by hand just to find their daily support and resistance. But let's be real, today's explosive markets absolutely require an upgrade. The standard formula derives 7 fixed levels based on yesterday's high, low, and close. But the expanded formula, it adds a fourth layer of resistance and support, R4 and S4, specifically designed to catch modern runaway trends. Plus, it introduces the highly dynamic central pivot range. This upgrade essentially gives you a much wider, way more dynamic net to catch those major price swings. When you visually map out this core math, what you're basically doing is taking the prior period's most extreme bullish expectation, the high, and the most extreme bearish expectation, the low, along with the closing consensus. You mix those together to plot exactly where the battlefield is drawn for today. The central pivot acts as your anchor. You've got 3 resistance levels stacked above it and 3 support levels stacked below. It's literally drawing the boundaries of today's price action before the opening bell even rings. Moving on to section 2, the central pivot range, which is really the core engine of this whole system. Professionals affectionately call this the meat of the market. The central pivot range, or CPR, is the true equilibrium point. It's made up of this dynamic trio of lines, the top central, the central pivot, and the bottom central. Honestly, think of the CPR as the Swiss Army knife of pivots. Depending on the day, this single cluster of lines can act as an impenetrable wall of resistance, a rock-solid floor of support, or even an undeniable magnetic target. Just like the moon controls the tides of the ocean, the CPR exerts a gravitational pull that controls the daily tides of the market. And this brings to mind a legendary quote from trading pioneer Jesse Livermore. He said, "The way to make money is to make it. The way to make big money is to be right at exactly the right time." So the crucial takeaway here is that timing is absolutely everything in this game. Understanding the central pivot range is exactly how you align yourself with the right side of the market at the perfect moment. It literally tells you when the market is totally out of balance and when it's about to snap back. Okay, section 3, pivot width forecasting, also known as the predictor. So we know where the key levels are, but what if I told you we can actually forecast future behavior based on current pivot width? It's all about the rubber band effect. Whenever you see a very wide pivot width, it tells you the market experienced a massive move the day before. The rubber band is stretched to its limit, the market is exhausted, and today will likely be a quiet, sideways, or trading range day. So you should definitely lower your expectations. But if you see a narrow pivot width, that means yesterday was quiet and tightly compressed. Energy is coiling up. The rubber band is getting ready to snap, signaling that a highly explosive trend or breakout day is imminent. You can see this rubber band effect snapping perfectly in action if you look at a typical chart, like Apple on a 15-minute time frame. Notice how, on certain days, the pivots are stretched incredibly wide. And what happens? The market just chops around sideways. It's totally exhausted. But then, look at the days right after. That quiet trading causes those pivots to compress into a very narrow band. That tight width basically telegraphs an explosive move. And sure enough, price breaks out into a massive directional trend. It is literally like having a weather forecast for market volatility. Next up is section 4, two-day pivot relationships, and how they give us our directional bias. Now that we have a good idea if the market will move, we can actually figure out which direction it's going to go using a remarkably simple cheat sheet. By comparing where today's CPR is located relative to yesterday's CPR, we unlock our directional bias. So if today's pivot range is higher than yesterday's, you have a higher value relationship. That's bullish, meaning you want to be buying pullbacks. If it's a lower value, it's bearish, so you should be selling pullbacks. An inside value day means today's pivots are completely swallowed up by yesterday's, signaling a high volatility breakout. And an outside value day, that typically leads to a sideways, choppy trading range. These essentially map out into 7 distinct block patterns representing 2-day pivot relationships. By just memorizing these simple configurations, higher value, lower value, inside, outside, and their overlapping cousins, you instantly gain a directional roadmap for the session. You'll know exactly what side of the market you should be trading on and what setups to look for before a single tick of the opening bell is even recorded. Talk about an edge. Finally, Section 5, Executing the Magnet Trade, which is where we put the application to work. This is where the rubber really meets the road. We're finally taking all of this incredible theory, the expanded pivots, the CPR equilibrium, the forecasting, and we're using it to execute a high-conviction, rapid-fire trade setup. Honestly, I want you to treat this specific setup like a heist. You have a very specific set of criteria. Step 1, you wait for the market to open with a sudden price gap away from the prior day's close. Step 2, because that gap represents an emotional imbalance in the market, you watch the central pivot range exert its gravitational pull on the price, acting as the true equilibrium point. And step 3, as price inevitably reverses course to seek balance and fill that morning gap, you execute the trade, writing it right into the CPR for a fast, calculated profit. When you watch this play out in real time on something like the E-mini S&P futures, it's wild. The market gaps open heavily, dropping all the way down to find support. But notice where the pivot lines are. They're way up above, near the previous close. The market is stretched way too far from its equilibrium. Almost immediately, it gets pulled back up by the magnetic, gravitational force of those centrals. It rallies powerfully, reversing course to perfectly fill the gap and hit the pivot target for a textbook, high-probability win. It's honestly a thing of mathematical beauty. We've covered a tremendous amount of ground in today's explainer, from the expanded formulas to the undeniable pull of the magnet trade. So I'll leave you with a final provocative thought. Now that you know how to read the true mathematical heartbeat of the market, are you really going to keep relying on lagging, backward-looking indicators? Stop guessing. Take these leading mathematical concepts, look at your charts in a completely new light, and ask yourself, how will you adjust your trading plan tomorrow?